Hey folks, it's Vince Gaetano here. We're going to talk about the good, the bad, and the ugly in this year's mortgage and real estate market. Let's talk a little bit about the TREB numbers first. Not a lot going on. Almost the most dismal numbers since they started tracking all this data, from what I understand. November came in with about 4,236 sales. And when you really drill down into this, it's not a whole lot, okay? We're seeing probably the lowest number since TREB's been keeping stats. I think it's been about 30 years or so. And we now have 3 to 4 million more people in the area. So when you really drill it down, it's not a good number, not very frothy at all. And when you think about what's happening with property values, I like drilling down into periods of time. And over the last 6 months, folks, we've seen a 9.5% drop in values. That's the average selling price on TREB, okay? Back in May of 2023, the price of homes were about 1.196 million, and in November it was 1.079, so a drop of 9.5%. Now, when you look back at the peak, and I'm going to take you back to February of 2022, the average selling price less than 2 years ago, it's about 21 months ago, the average selling price was 1.334 million, and that is a 19% drop in November. When you look at the peak of February 2022 to November, it's almost 20% drop. When you look at the November numbers, some things that point out to me, the biggest segment of properties sold were detached in the 905, representing 33.5%. That was 1,420 home sales of the 4,236. The least amount, detached in the 416, only 461 homes sold, representing about 10.9% of all sales in TREB. So at the end of the day, it's not a very active market, not a lot of activity, and the reason being is interest rates still are a little bit higher than they should be. And the reality is I've always been saying this for those that you watched over the last few years, people don't buy houses, they buy payments. And with rates at these elevated levels, we're seeing a difficult time for folks to afford these prices. Condos in 416 were a big chunk, 825 sales in November, representing almost 20%. So, you know, people are dealing with lower priced property for the most part, what they could get into. Now, when you look at it, everybody says, well, this isn't the best time to buy anyway, so what's the big deal? It's a slower time. The reality is when rates are low, it's always a good time to buy. When rates are high, people get into those traditional spring and fall markets, but we are still troubled with affordability. And that continues to be a very concerning issue. And I do believe big purchases are not being made because there is employment uncertainty. There are lots of businesses laying off. We're seeing the banks lay off in the thousands. We're seeing different businesses close down. We're seeing retail almost come to a slowing. Yes, it's Christmas, but listen, I got Yorkdale up the road. That parking lot's not full. I need to get under that Dufferin Street Bridge to get home. At this time of year, it would take me 20, 25 minutes just to get under that bridge. I'm getting home pretty quickly, and it's the second week of December, okay? Like, we're now approaching the second weekend of that Christmas shopping season there, okay? Because it always starts a little bit earlier. And it's really interesting. I'm going to keep an eye on it, but I'm looking over in that parking lot. It's not full. It used to be right up to the sidewalk on Dufferin Street, parking spots full. They're not full right now. So I'm going to keep an eye on these retail sales. Yeah, there's people walking in and looking at stuff, but stuff is not at the level that it's traditionally at. Now, I'll let that go for a minute. I want to talk a bit about the good, the bad, and the ugly of the year. And, you know, I've seen countless posts about what the Bank of Canada did. We all know it was a nothing burger yesterday. I think everybody's just exhausted talking about that. But one thing is for sure, the good in all of this, and we're going to go through the good, the bad, and the ugly. The good in all this is that rates are probably at a pause. I think we've hit the top of the interest rate hike cycle. I think Tiff and his gang at the Bank of Canada has really put a nail in that coffin of further rate hikes. We are seeing the economy slow. As I've always told folks, you got to respect the lag. And we've come to that realization that we are not going to see further rate hikes with the variable. Okay, that the Bank of Canada primarily triggers that variable rate, HELOC rates, any floating type of interest rates that you will be dealing with, whether it's unsecured credit card, unsecured lines of credits, HELOCs, and variable products. The bad in all this is that rates are still high. Rates are still high, plus you add the qualifying rate, the qualifying criteria of the stress test, which is the additional 2%, and you have a bad situation where people still have a lack of ability to qualify for mortgages they need to buy these homes at these levels. And to put things into perspective, okay, since 2011, home prices have almost doubled and incomes have only gone up by 25%, okay, in the grand scheme of things. So when you have the values of homes doubling and your income trailing on that growth trajectory and not keeping pace with the level in which homes are going up, it's becoming a problem. And that's where that difficulty lies. Down payments have to be larger. You're relying more heavily on family and parents to help you out. You're seeing more people on title. You're seeing a change to the way the traditional property is being bought. It's not your standard couple that's buying it. You're buying with a family member. The makeup of that application is changing dramatically. And that's bad. It's not necessarily healthy. You know, I was watching Ron Butler and Mike Moffat, Professor Mike Moffat, on the Hurley Burley YouTube podcast. I really enjoy the podcast. And there was a point made that really resonated with me, and that is home ownership was the staple of the middle class. And we've come to a point where the middle class can no longer afford homes. So, you know, when you have a government that's been preaching to support the middle class and those that want to join it, over the last decade, we've seen an erosion of that dream of home ownership because the middle class can't achieve it. We have folks that are offering essential services to the folks in urban cities and urban centers across this country that can't even afford to live in them. And that is a problem. That is the first step to the deterioration of what we've come to appreciate, and the cost of living is going to continue to go down. Now, the ugly in all this is really interesting because the ugly is what's coming. And from now until the summer, we're going to continue to see folks that are coming up for mortgage renewals. Now, not everybody has a mortgage. I think it's 35, under 40% of people have mortgages. You have renters, and then you have folks that don't have any mortgage at all because they own their houses outright. These are the seniors, baby boomers, whatever. But these folks have the ugly segment of what I'm going to talk about. Because anybody that's renewing their mortgage is going to be dealing with payment shock. Anyone that's coming up for renewal, and there's about 75,000 to 100,000 mortgages coming up for renewal each and every month, they're going to see a significant increase to their interest rate from what they were paying previously. And it's going to adjust their household expenditures. Their disposable income is going to be eroded by debt costs. And you're going to see further deterioration of the household budget. Okay? And this is going to happen gradually over the next 6 to 7 months. And when you see further challenges with new builds, because developers are not building, okay? As you've seen, more and more are catching fire. Every week there's another fire at a development site. I don't think that's a coincidence. But what's interesting is that as this government continues to bring folks into the country, because the immigration cycle is still happening, people still coming here, okay? They're not going to have places to live. And it's going to create a further problem. It's just going to be, the can's being kicked down the road, and there's going to be further challenges on the housing front. And you're going to have people not able to make payments, and something's going to give. I'm not sure what it will be, but it will be a challenge, and it'll be very, very interesting to see how this all plays out. But let's all be prepared for what's coming. Let's all make sure we're aware of our spending. As I've told you many, many times in the past, pull out your bank statements for the last 6 months, pull out your credit card statements, pull out the paper copies and look at what you're spending money on. And circle those things that are wants, focus on the needs, start looking at ways to save money so you have more money in your pocket so you could withstand what is going on. You know, the peak impact of the damage is still going to be felt, and it's going to be very problematic for those that are not prepared. Okay, so if you can brace yourself for the next 12 to 18 months, you're going to be in really good shape. So I really encourage you to do that. Now, I want to talk a little bit about the bond market. The 5-year bond market has moved in the right direction. So what we will start seeing is that although the Bank of Canada is holding firm and not decreasing, we are seeing some relief in the fixed rate products. We're seeing some banks drop some rates, albeit not at the same pace that they're coming down. But we saw, today we saw the 5-year Canada bond drop below the 3.5 range. It's now sitting at about 338. And just 2 weeks ago, we're sitting at 380. So that's over 40 basis point drop, which bodes well for those looking at renewals. Still going to see rates in the 5s. We did see a 5-year insured mortgage kicking at $4.99. I think it was a promo for a short period of time. Only a small sliver of people are going to qualify for that, but it is good news because it's not in the 6s anymore. We're starting to see those high 5s, low 5s in that range, and that bodes well. And it gives some people some options, because if we are going to start seeing some rates coming down at some point into the future, do you want to lock into a 5-year fixed rate at this point in time? Maybe you should opt for a shorter period mortgage, or even a variable if you have the stomach for it, and hold off at those higher levels until rates start coming down. As I've mentioned in the past, the variable product does give you that ability to convert into a fixed rate at any time, and you may want to time it. One thing I always explain to clients with renewal dates, sometimes you feel you're a slave to the date. Okay, you're stuck, you're kind of pigeonholed into this renewal date, and you got to make a decision. It's very important to know that you do have options to take control of when you lock in, and there are tools and products out there that will allow you to do that. So if you do need help in any way, shape, or form to kind of understand your options, and you need help, reach out to your mortgage professional. Our office is always available to help out. We're helping many, many folks assess what is best for them and their families as they deal with this payment shock with renewals. And I encourage you to reach out, give our office a call. We're here to help, and we'll do our best to give you all the options available to you. The Porsche tracker, I didn't track it today. We've had some problems in the office. Our heating went, so we got people on the roof bouncing around. I've been talking to folks about making sure this heating works, and didn't have a chance to track that, so I'll get that to you next week. But let's get into the other part of our show, and that is question and answers, okay, from your DMs, emails, texts, and whatnot. Appreciate it. We're going to get right into it. So buckle up, put on the helmet, tighten up, and let's go. First question. How might recent changes in interest rates impact my current mortgage and any plans for refinancing or purchasing additional properties? Okay, so with the rising interest rates, people's ability to qualify for the maximum amount has been dented, okay? People have been cut at the knees with the stress test. Higher rates allows them to borrow less. There's less opportunity to get into investment properties. Nothing's penciling. And what I mean by penciling is nothing's cash flowing positively. It's very, very difficult to do that. Unless, of course, you have a property and you want to repurpose it. You want to improve it. You want to maybe take a single family and convert it into a 4-unit property as per the new legislation that's been put in place. So, these are interesting times. We are seeing interest rates move down on the fixed rate side, so there is hope. It's going to take a long time to get to a more reasonable level. We're never going to see the low rates that we got accustomed to during COVID. I'm sorry, but that's not going to happen in my lifetime. I'll be retired and gone before that ever happens again. But hopefully they'll normalize, and they'll normalize to something in the 4s and 5s. So I think what it's done is it's changed the mindset from maybe looking at repurposing existing housing stock or properties you have, adding a basement unit, looking at other ways to add additional revenue streams. And if you need help in that regard, please give us a call. We have been working with a lot of folks that are repurposing in the city. I'm going to have some videos out about some of those projects soon, and I'm hoping to share what is possible for properties in the city and help you get a visual look at what these things can look like. So thank you for that question. Next one. Given the economic uncertainties, what strategies can homeowners employ to safeguard their investment and ensure financial stability? Well, this is an interesting question because there's a number of different angles you could look at it. Economic uncertainty could mean a few different things. It could mean employment. It could mean higher interest rates. It could be higher cost of living. It could be a number of things. And what I think people need to do during these times is to be very prudent with their money. Everybody's working very, very hard to save money or make money, so you have to save as much as you can. So you gotta avoid the frivolous expenses. You have to get rid of things that you don't need. Try to limit your spending. Try to eat at home. Try to buy your groceries and staples at discounts and in bulk to get an edge. Every little bit counts. And I don't think taking risk in this time is really smart. I think you really got to be careful where you invest your money. So, think it through, do your due diligence. Okay, if it sounds too good to be true, chances are it is. And, I was talking to a good friend yesterday, went to lunch, Nick Hill. He has a podcast called The Canadian Real Estate Investor. And, a gentleman was trying to get into the market with $40,000 of RSP money, and he thought he could get into the flip business. He was talking to some investor about flipping his $40,000 into multi-units and whatnot with 40 grand. Like it sounds too good to be true. You got to be very careful. It's not going to happen. Just be weary of stories that sound too optimistic in these times. Got to be very, very careful. So hold on to your money and be very prudent. With employment uncertainties, what advice do you have for homeowners facing financial strain in meeting their mortgage obligations, and are there any relief options available? Okay, unemployment's increasing. Okay, we've gone from the trough of 4.9% to 5.8% last month. That's the highest change in quite some time from trough to peak. We haven't seen 0.9%, without a recession looming. Okay, in the last 70 years, we haven't seen a 0.9% change that fast, and that means job losses are coming. Okay, and to protect yourself, you should have emergency funds. You should have some type of savings to withstand it. Start looking at alternative ways of earning a part-time job. Start figuring out what opportunities are out there that you could kind of jump on before it's too late. You need backup plans, and you have to start curbing your expenses, okay? Because if that revenue number starts to get impacted, you got to start cutting expenses. As far as relief programs are concerned, make sure you be proactive with lenders. If you have debt obligations and you run into a situation where employment is strained or you're looking at a layoff, communicate with them, okay? Lenders are very eager to help those people that are proactive with their situation, okay? These things happen, okay? They happen all the time. They're not new to lenders. And when you are proactive with them, there's a better chance that they're willing to work with you and give you some solutions to get through it. And it's best to be ahead of the situation than trying to avoid the reality of it, put your head in the sand, and not deal with it head on. So I encourage folks that are dealing with these type of unemployment situations, reach out to any lenders, any debt obligations you have, and ask for some relief. You'd be surprised what they would do for you. What are some of the ways we can reshape how we buy and sell homes? That's an interesting question. Well, I guess what's happening because of the affordability crisis, as I've mentioned in the past, the makeup of the buyer has changed. We're no longer seeing two people on title. Over the last several years, especially since the stress test has kind of kicked in 2017, 2018, on a more broad basis, we're seeing an increase in the multiple applicants on file on a mortgage. Okay, we've gone from 2, which was traditional, to 3, 4 people, in some cases 5. And the makeup of the family unit has changed because I think more and more people are realizing how out of reach homeownership is, and they're buying with family members, they're buying with friends. You know, I joke around that the new term is going to be step friends. You know, 2 couples buying a home together, and their kids end up growing up together, and they're step friends. We're going to start seeing changes like that, and I think it's going to be more and more so with the unaffordability of homes. So I do believe everybody still wants a detached home with a backyard. I think the delivery of the product has to move away from 1-bedroom condos to a more family unit based property. I think we're going to find that the 1-bedroom condo is going to be in abundance as far as what's out there, and we'll have to see if developers start thinking about it. I think you start having to think about, how do we get seniors to give up their homes? How do we have them free up those properties so that new families could buy them? And I don't think there's much thought into senior homes, you know, or senior residences in urban communities. And we got to start thinking a little bit differently about that. It was mentioned by Professor Mike Moffat in that podcast that I was talking about earlier, the Hurley Burley podcast that just came on. And he talks a little bit about how we could get seniors to give up their property so they can move into more gentle and easy access senior living properties. And you know, one of the biggest challenges seniors have is they don't want to go into a condo. All condos are in the core, in downtown. They want to be in their neighborhood. So how do we build more gentle, easy to reside in properties in the communities that they live in, and free up their homes for new oncoming families? So it's going to be really interesting to see what we come out of this mess with, as far as new ideas and how we could build communities that work for everyone, and eliminate the hoarding of assets that are in need for new families to come into them. Take one more. Do you think AI will one day take over the job of real estate agents? Well, that's a great question. What I will say is I think AI will serve a purpose in the space in some situations. One may be new construction sites. AI could probably navigate through construction sites because everything's on plans, right? Like when you go to a construction site, there's nothing there. They don't do model homes anymore. You're buying in a field. Why do you need realtors to show you what a field looks like? Like, I think there's going to be probably a place for AI in the real estate and mortgage space and all services, but I don't think it's going to replace them. I think they will take on certain roles that aren't as detailed and can be done for those that just want information and basically need to make decisions based on numbers and data. But as far as people that need to touch and feel and visit and know what space feels like and all that, you're still going to need real estate agents and service providers to do all that. So on that note, I'm going to wrap it up. I want to thank everyone for participating today. And I want to encourage everyone as we get into the holiday season to think about the homeless, those that are using food banks. We are hitting a crisis in the Toronto area. We're going to probably hit 3 million visits to the food banks in our city this year, which is disappointing and upsetting. And if anyone has the ability and the resources to donate non-perishable goods to your local fire hall, please do so. Fire halls will deliver those to the Daily Bread Food Bank and get those goods to people that need it. It is getting colder out there, and we need to start thinking about folks that are without homes. And anything you could do to help, I encourage you. I want to thank you all for participating. I want to thank you all for your encouragement, your insight and comments and feedback. Please send your questions. Send me what you want discussed in future shows. I'd be really eager to look it up, do some research, and pass on my insight. Thank you again. Have a great evening. Take care.